Welcome to The Explainer. We're going to jump right in today because, honestly, we are currently standing right on the precipice of the largest initial public offering in human history. Elon Musk is getting ready to take SpaceX public, and it's targeting a valuation that is, quite frankly, hard to even wrap your head around. But what's actually happening behind the scenes of this historic financial event is way more complex and a whole lot more concerning than the headlines might suggest. So let's break this entire thing down piece by piece and uncover what you might actually be buying into.
$1.75 trillion. Let's just pause on that number for a second to really grasp the staggering scale of this target valuation. At this price tag, SpaceX would be worth more than every single American defense contractor combined. We're talking more than the market caps of Coca-Cola, McDonald's, Disney, Nike, and Starbucks all smashed together. It even eclipses the top 10 companies on the entire London Stock Exchange. It's just a monumental figure, right? And a price tag like that absolutely demands a flawless, bulletproof business model to justify it.
But here is the central mystery we really need to solve today. If you look at the actual consolidated financials of the company right now, SpaceX is currently losing roughly $5 billion a year. $5 billion. So, the absolute crucial question is, who on earth is buying a company that is hemorrhaging that kind of cash and doing it at the highest IPO valuation in history? Well, spoiler alert, the answer is you. But before we get into exactly how your money is being pulled into all this, we first need to understand what this company actually is.
Which brings us to the reality of the situation. 3 businesses in a trench coat.
See, if you ask 10 random people on the street what SpaceX sells, almost all of them are going to say rockets, right? Maybe a few will say it's about colonizing Mars, but they'd actually be wrong. SpaceX is not just a rocket company. It is essentially 3 completely distinct businesses, all stacked on top of each other, basically wearing a single corporate trench coat. And to make any sense of this IPO, we have to pull this complex financial structure apart. Looking at the 2025 revenue breakdown, the thing SpaceX is most famous for, the rockets, makes up only 25% of its revenue. A massive 61% chunk actually belongs to Starlink, with the remaining 14% falling into other ventures, most notably their recent acquisition of the AI lab, xAI. Let's look at how this builds, starting with the most famous, but surprisingly least financially dominant piece of the company.
First up, Business 1, what I call the rocket facade. This is the part that hogs all the media attention, right? Launching satellites for the US government, running cargo up to the International Space Station, doing crewed missions for NASA. Undeniably, it is an incredible technological feat, but strictly from a financial perspective, the rocket business generated roughly $4 billion in revenue last year. Now sure, $4 billion sounds amazing in a vacuum, but compare it to that $1.75 trillion valuation we were just talking about. Suddenly, it's literally a drop in the bucket. A $4 billion revenue stream doesn't even come close to justifying a nearly $2 trillion price tag. So, bottom line, the rockets just aren't paying the bills.
So let's move on to Business 2, the Starlink cash printer.
This right here is the true crown jewel of the entire company. It's the hidden engine that investors actually care about, and it's the piece funding literally everything else. One venture capitalist perfectly described Starlink as Comcast in space. Since launching its beta back in 2020, it has quietly become the fastest scaling telecom company in human history. We're talking about a massive network of over 10,000 satellites up in Earth's orbit, beaming internet down to more than 10 million active subscribers across roughly 150 countries. And it's not just consumer internet either. They've got maritime versions for huge cargo ships, aviation versions for commercial airlines, and even a classified defense version called Starshield that has active Pentagon contracts. The entrepreneur Scott Galloway even called it the single best product of the last few years.
Because Starlink is an absolute cash printer. It alone pulled in $11.4 billion in revenue for 2025. But you really have to look at this margin expansion because it's wild. Just 2 years ago, Starlink's profit margins were sitting around 41%. This year, they have skyrocketed up to 63%. They basically added over 20 points in margin expansion in a mere 2 years. So the margins aren't just high, they are accelerating incredibly fast. Honestly, if SpaceX was strictly just Starlink and rockets, they'd be posting roughly $8 billion in pure profit right now. But, well, they aren't.
Which unfortunately brings us to Business 3, the xAI money pit.
This is the downright ugly part of our 3 business mashup. xAI is the AI lab founded in 2023, basically designed to compete with OpenAI. Well, a few months ago, SpaceX acquired xAI in an all-stock deal that valued xAI at a staggering $250 billion. I kind of like to think of this segment as the reverse Jerome Powell, because instead of printing cash, it just ruthlessly burns whatever cash the rest of the business manages to generate. To really grasp how wildly overvalued this acquisition is, just look at the market leaders. OpenAI generates about $24 billion in annual revenue and gets valued around $850 billion. Anthropic makes over $30 billion, valued at $400 billion. And then you have xAI. They're sitting on an estimated $1 billion in revenue, yet they were just bought for $250 billion. The market is basically pricing xAI like it's a premium luxury airline, when based on the actual numbers, it's flying budget. But oh, it gets worse. xAI was originally founded by 11 elite researchers poached from heavyweight labs like DeepMind and Google. By 2025, though, the company was burning through more than $1 billion every single month. And then, by March of this year, every single one of those 11 co-founders walked out the door. Elon Musk even publicly admitted on his own social media platform that the asset basically had to be rebuilt from the foundations up. So if you're keeping track, SpaceX essentially just paid $250 billion for a massive cash-burning asset that needs a total from-scratch rebuild.
So, let's tie this whole complex financial structure together. You've got Starlink and the rockets doing fantastic, generating about $8 billion in profits. Amazing, right? But then xAI shows up, completely ruins the party, and proceeds to light roughly $1 billion a month on fire. The end result? A consolidated net loss of $5 billion on $18.5 billion in total revenue. So I have to ask you again, who exactly is buying this completely unprofitable mashup at a record-breaking valuation?
Well, that takes us to our next point, rewriting the NASDAQ rules.
Because the real story here, the one you absolutely need to pay attention to, isn't about rockets or magic space satellites at all. It's about how the financial system quietly changed the rules right before this specific IPO. Check out exactly what happened on May 1st of this year. The NASDAQ 100 is basically the gold standard index for tech companies, and tracking it dictates where billions and billions of investment dollars automatically flow. Well, NASDAQ suddenly introduced new rules that just so happen to be perfectly tailored to SpaceX's target June IPO. First up, they tweaked the fast entry rule, cutting the mandatory waiting period to join from 3 months down to just 15 days. That massively compresses the time for essential price discovery. Second, they looked at the free float minimum. You used to need 10% of your shares available to the public to get in. SpaceX only wants to list about 4 to 5%. Very conveniently, that 10% rule was completely scrapped. And third, they added this hidden multiplier. If your float is under 20%, NASDAQ now mathematically treats it as if it were 3 times larger.
All of this creates a very specific phenomenon known as manufactured demand. By rolling out this red carpet, letting SpaceX join with just a tiny 5% float, letting them skip the normal 3-month seasoning period, and artificially tripling their weighting, NASDAQ has essentially ensured that ETFs and passive index funds are legally forced to treat SpaceX as a massive, immediate priority. They are legally mandated to automatically buy the stock, generating billions of dollars in automatic, unquestioning investment capital.
And that brings us to the final piece. You are the buyer.
This is where all that complex financial engineering comes directly back to you, the viewer. Normally, IPOs allocate maybe 5 to 10% of their offering to retail investors, everyday people like you and me. SpaceX, however, is targeting a historic 30%. Why such a huge chunk? Well, SpaceX's own CFO, Brett Johnson, literally told a room full of bankers that retail buyers have been incredibly supportive of them and are, quote, loyal to Elon. So the plan is to dump 30% of this historically massive supply directly onto retail buyers, banking heavily on brand loyalty rather than actual financial fundamentals.
So the absolute crucial point here is how this whole timeline actually plays out. The buyers, meaning index funds and retail investors caught up in the hype, are forced in early. But the sellers, the insiders who are sitting on a super low cost basis, their shares get unlocked later. Meaning the shares will move directly from the insiders right into passive funds and your retail retirement accounts at the absolute peak valuation. As portfolio manager George Noble so bluntly put it, your 401k is the exit liquidity. We have always been told that passive investing is the quote-unquote smart way to invest, right? Low fees, great diversification, you just set it and forget it. And historically, that's been largely true. But the exact same mechanism that makes it so incredibly convenient for you is the exact same mechanism that makes you a guaranteed automatic buyer for absolutely anyone who can squeeze their way into the index. And right now, an unprofitable mashup of rockets, satellites, and a collapsing AI lab just had the rules completely rewritten so they could squeeze right in. So I'm going to leave you with this. When the financial system fundamentally changes the rule book right behind your back, is setting it and forgetting it still the smart way to invest? Think about it. Thanks for joining me on this explainer, and remember to always keep questioning what's on the screen.